Hi, Jay. Thanks for joining me.
Thanks, Susie. It's great to be here.
Well, our clients are interested in contributing to causes they care about. The latest tax bill passed this summer included some new rules about taxes and giving that could significantly influence decisions on charitable strategies. Can you summarize these changes?
Yes. Recent tax legislation introduced several provisions that may influence how Americans give to charities this year and in the future in order to maximize tax benefits. These discussions are especially timely right now as many of us are looking to give to our favorite causes at this time of year. Being strategic with our giving not only helps us potentially maximize our impact, but it also allows us to continue to leverage one of the only consistent tax levers still available. In terms of the new provisions, there's quite a few, but I'll start with three. The first two are for donors who itemize their taxes. First, beginning in 2026, there is a 0.5% floor that must be met before itemizers can deduct their charitable gifts. As an example, a taxpayer with an adjusted gross income of $200,000 will only be able to deduct charitable donations above and beyond $1,000. So that taxpayer's 2025 donation of $8,000 would be fully deductible. But in 2026, that same gift would only allow for a $7,000 deduction, given the $1,000 floor. Second, the new legislation caps the tax benefits of itemized charitable deductions at 35% for those in the 37% marginal tax bracket, so they will see a greater reduction in the value of their donation. For example, if you donate $30,000 in 2026, your potential tax savings will only be $8,700 versus the $11,000 if you made that donation this year. And the third provision is for those choosing to take the standard deduction. Beginning in 2026, there is an above-the-line charitable deduction for contributions of up to $1,000 for single filers or $2,000 for married couples filing jointly. There are some limitations, including the fact that these contributions have to be made in cash and made directly to the nonprofit. But overall, this is a change that we believe will empower more people to give to the charity of their choice.
Those are some significant changes. So what does that mean for our clients who are interested in giving this year?
If you itemize your taxes, giving in 2025 could offer better tax benefits versus waiting until 2026 when the new limits on the charitable tax deductions go into effect. One popular strategy we anticipate we will see more of this year is the notion of bunching your donations. Bunching simply means accelerating multiple years' worth of gifts into one, which can help taxpayers exceed the standard deduction or further increase tax savings if they're already itemizing. This is important to note because a lot of taxpayers haven't been itemizing since 2017 when the standard deduction was doubled at that time. One reason giving now is even more appealing is that the new tax law increased the state and local tax deduction, known as SALT, from $10,000 to $40,000. The provision is effective for tax years beginning after December 31st of 2024. For donors in higher tax states, this could increase the incentive to give because now their combined deduction, SALT, charitable, and mortgage interest might exceed the standard deduction.
Well, you mentioned cash donations earlier, but what about non-cash assets like stock or cryptocurrency?
Using your investment portfolio for giving versus your wallet or checkbook can potentially be a very tax-efficient strategy. When you donate long-term appreciated assets to a charity, you generally do not pay capital gains tax. You are also eligible to claim an income tax deduction up to 30% of your adjusted gross income. When it comes to more complex non-cash assets, such as cryptocurrency, the benefits are similar in that you can reduce your capital gains and qualify for an immediate income tax deduction, which is generally the fair market value that is provided by an independent qualified appraisal. We really see a wide range of assets for giving, like private business interests, restricted stock, and private equity.
All right, well, we've discussed using tax-efficient assets and giving strategies like bunching. What's another strategy to maximize the tax benefits of your gift?
It's also important to consider tax-smart accounts for giving as well. A donor-advised fund is one of those options. Just like you have an IRA account for retirement and a 529 account for college savings, consider a donor-advised fund like a charitable investment account. With a donor advised fund, donors can make irrevocable contributions and take an immediate tax deduction, invest their contribution for potential tax-free growth, and then make grant recommendations to IRS qualified charities in the time frame that works best for them. A donor advised fund is a helpful option for those looking to accelerate their giving, use a bunching strategy, or donate stock between now and the remainder of the year. In addition, a donor-advised fund can simplify your record keeping and streamline the donation process, as well as support your legacy planning. Fidelity Charitable, an independent public charity, is the largest donor-advised fund sponsor in the United States. Additionally, we're also the largest grant maker.
Well, many of our retired clients are concerned with taxes, especially on required minimum distributions from tax-advantaged accounts like IRAs. Are there charitable strategies that can help?
Yes. There's a specific age-based strategy called the Qualified Charitable Distribution. Americans who are age 70 and a half or older are eligible to direct up to $108,000 from their IRA to go directly to a charity or charities tax-free. In short, you are making a direct gift to a charity, and it comes right off the top of your income. It's not an itemized deduction. And this can be particularly powerful if you are over the age of 65 and you're subject to Medicare premiums and the income-related Medicare adjustment amount. The drawback is you can't direct these qualified charitable distributions as donations to donor-advised fund sponsors, even though they are charities. So it's really important to meet with a financial professional to weigh the pros and cons of each strategy. That being said, it's never an either-or situation. There may be benefits to both strategies.
Well, Jay, this has been great information. Thank you so much.
My pleasure.
If you have questions about tax-smart giving, reach out to your Fidelity representative. If you don't have a Fidelity representative, visit fidelity.com/findinadvisor. And for more timely news and thinking from Fidelity's top thought leaders, subscribe to Insights from Fidelity Wealth Management. I'm Susie Allen. Join me again soon.